In this week's video, we'll review the latest charts and data and a rope-a-dope move by the NASDAQ to help us answer the question, what's next for stocks? We'll be moving quickly, so feel free to use the pause button on your video player. Some key points from the February 17th video. At that point, market leaders were still above upward sloping 30-week moving averages. Their weekly clouds looked good. We hadn't experienced significant damage to emerging trends, and we didn't have any hot knife through butter looks yet relative to important levels. And at that point, we were still in so far so good mode. Fast forward a week to February 24th, and things were looking a little bit more dicey, but as we mentioned, the weakening momentum really hadn't resulted in enough deterioration in the charts and the evidence to justify any big moves. So heading into this week, we knew that may change very, very soon, but we wanted to see how it was going to play out. In Q4 of last year, there really wasn't a lot of confidence in the tape, and that started to change in early January of this year. Thus, one of the primary ways that we monitor orderly relative to disorderly on a pullback is via the tape. As of March 2nd, looks like a breakout, and right now, a successful retest back above the line. You can pause your video player here. There are some characteristics between 2020 here and the present day. S&P 500 up-down volume. Notice how price is starting to stay above the 50-period moving average, similar to this point here and this point here, and quite a bit different from all of this. Still holding the breakout, trying to make a stand at the 200-day moving average. Significant outside reversal this week. This is last week's bar. This is this week's bar. This is the low exceeding this low. The close and the high exceeding last week's intraday high. Weekly semiconductors above an upward sloping 200-week. This is on our Twitter feed. You can find it at @Shavaco Capital. Comment applied to the chart intra-week, and it applies to the chart as of March 3rd as well. You can see here holding the breakout and above a very, very important band. Weekly cloud as of the close on March 3rd. It's fair to say this is a market leader, and if it can hold this look, it's very, very encouraging for the rally attempt off the October low. Green above price, yes. Price above red, yes. Blue above red, yes. Price above the cloud, yes. We recaptured the cloud during Friday's session. Has the cloud shifted from red to green? Yes. End of the week, batting a Wade Boggs 5 for 5. You can pause your video player and read the tweet. Constructive look at the end of the week, and a not too alarming look during the week last week, before the reversal. This tweet is Wednesday night. The market didn't reverse until Thursday afternoon. Right before lunchtime on March 2nd, which was Thursday, when the market was still down for the week, that's down here, the NASDAQ came back to this gap and ended up rallying nicely. Also holding an important level here, came back and tagged the 200-day moving average, and thus far has held. Wednesday night, we had some try to be patient and see what happens reference points. This is 8:32 p.m. The weekly chart trying to make a stand at a very logical level here, and momentum still holding well. Looks like a bullish breakout and a retest. This is a nice bullish divergence here relative to the MYA down here. Breakout above these levels here. Right now, it looks like a retest. This is during the session on Friday. This is still a constructive look relative to anything back here. So is this. It's a 12-period average here. New highs, new lows. It looks different than anything that we saw here in 2022. Momentum has regained some of its mojo. Still have a constructive look here. Daily chart, 200-day in red, 50-day in blue. It really speaks for itself back above this level here. A lot of improvement on the weekly cloud. Always good to have reference points thus far holding near logical levels. You can find this tweet on our Twitter feed. This is Thursday evening at 9:40 p.m. The basic message here between the lines was, if leadership hasn't changed relative to leadership in early January, That basically speaks to an orderly pullback. If it were a disorderly pullback, then you would expect the leaders to wane and some shifts to take place away from cyclicals and toward defensive assets. This moving average cluster is the 50, 75, 100, 125, 150, and 200, coming back to a logical level from numerous perspectives and thus far holding. We trade the chart in front of us. This is mid-October last year. The S&P 500 bottomed on October 12th. Remember earlier in the year we said early in January, around January 4th, things are looking better. Similar look in the present day. 3:46 p.m. on March 3rd. If you look at this objectively, this is January of 2022. This looks different from anything that we've seen in the rearview mirror. Daily cloud came right back to the cloud and thus far has held. You can read this here. This is exactly what you want. This is textbook. After this bullish look here, when sentiment starts to turn, you're hoping on the pullback that sentiment tanks and everybody gets nervous and says, here we go again. It appears that's exactly what's happened. You can see we came back to the drawdown levels relative to the February 10th breath thrust that we covered in an earlier video. Historically, you come back here and here for the average and median. There's also more information on our Twitter feed about breath thrusts and drawdowns. It's a nice clean look here. Came back to the 20-week, tagged it, and thus far have held. Look at all the white space down here. It looks different from all of this. Covered this chart for a long time. Looks pretty encouraging. Momentum turning up for the second time near zero. Out of oversold territory, very logical position to try to make a stand. Get a lot more confident about this stand if we can clear 4,200. That's to be determined. You have a ton of charts that look like breakouts and clean retests. All of this above an upward sloping 200 week after a short stay below the 200 week, which typically is bullish. This almost tells you that the institutions were waiting to buy down here. Haven't lost this constructive look, and this is as of 3 o'clock, March 3rd. This is still a good look here. Didn't lose a lot of momentum. Remember, for a long time we've been saying TSI in 2002 and in this bear market tried to recapture zero, couldn't do it and turned down. 2008 even worse. You can see all the white space here on this rally attempt right here, and this is the rally attempt here. So there's a lot of comparisons to 2002 right here and 2008 right here. Well, this is starting to distance itself significantly from those two periods. Couldn't close above zero here for 1 week. Couldn't even come close to doing it here. We now have a close above zero on weekly momentum for 5 consecutive weeks. And look at price relative to the 23-day moving average. If you look at it objectively, it looks a lot better than this. It does look similar to this, but this looks better than this. Doesn't predict anything, just speaks to odds. Once we gave up the zero line on the weekly with MACD in February of last year, we could not recapture it. We're still above after 3 weeks of weakness, still above zero. And notice we're still above 50 here. That would look like orderly, including coming back and tagging the 40-week and holding, which is different than this, and this. We've showed this numerous times. You can pause your video player. A lot of similarities between these bullish stands and the present day. It's late on Friday evening, so if you want to see what transpired this week, one of the best ways to do it is just Google Twitter @Shavaco Capital and just scroll through our Twitter feed from this week and see how things unfolded. If you're not on Twitter, don't know anything about Twitter, or don't particularly like Twitter, you can still Google this and still view the page like any other web page. Wednesday evening, numerous examples of constructive reasons to try to be patient. Remember last week we said, let's see how it plays out, or let's see how it unfolds. A, B, and C all turned out to be relevant. This is Wednesday evening here at 9:42 p.m. Eastern Time, where we pointed out that there were gaps here. I don't think we were expecting to go into the gap the next day, but that's what happened. We gapped up the next day into the gap, and you can see we were in the gap intraday, and then we closed outside of the gap, which was constructive. This also is a good look. Then we gapped down. Gap up, potential resistance, gap down, momentum at its lowest point. Have to go all the way back to January, back here. We didn't get that low here, have to go here. And remember, early January, things went well for the market. Market had a nice January. Also mentioned on Twitter, Friday session, March 3rd. Very similar look. We went into the gap, gapped into the gap, and then gapped out of the gap. Momentum here at the highest point for IEF, you have to go back again to early January. Also noted this on Wednesday about the US dollar appeared to be losing some of its mojo. Here's white space relative to the Bollinger Band. Momentum slowing. Technology is not a leader off of the October low, but we still want to see it rally, regardless of whether it's going to reclaim a leadership position, and that's to be determined. It has not done so yet. Trying to make a stand here, a very logical area. All of this occurring above the downward sloping trend line after the breakout. Could still go either way here, but this is a good start. This is a great illustration of trade the chart in front of you. History suggests the market has bottomed based on this simple 200-day, simple moving average envelope signal. And this is the key. This is hard data, not my opinion. If it upsets you, get mad at the last 28 years of price action. And that's very, very similar to what we've been covering since early January. The charts are the charts and the data's the data. We can't allow ourselves to get out of tolerance relative to the model, or else we have nothing to manage against. Hence why we've increased exposure slowly off of the October low and then more rapidly in early January. If you want to see what this looks like, it's pretty easy to see visually that when you drop below the envelope here and then recapture it, typically good things happen. Drop below, couldn't recapture it, have recaptured it. Very similar look down here to the present day, and that occurs after the low in 09. The difference here is we've already closed above the upper band. I believe the fundamental data is a lot better than the narrative out there. Here's another example. For stock market bulls, if the market can just hold its own and move sideways and consolidate these gains, typically good things happen later in the year. Constructive setup here for what I would call a non-US global laggard. Emerging markets don't look as good as developed markets, but they look like they're trying to turn. This was a big help. Liquidity in China, big factor relative to the October low. US dollar weekly lagging span above price, no. Price above red, no. Blue above red, no. Cloud, green, not anymore. Price above the cloud, no. Well below the Mendoza line. Trying to make a stand at the 200-day, it looks different. Left shoulder, head, smaller and bullish right shoulder, constructive retest, bouncing. Notice this is relative to the 30-week. Look how much better it looks than the 30-week for the S&P 500. Why is that? The S&P 500 is a laggard. This is global stocks ex-USA divided by the S&P 500 above a nice, firm-looking, upward-sloping 30-week. Yes, momentum is slowing, but still above the zero line and still above 50. And this is also very, very relevant about how long this type of leadership change could potentially last. Still have work to do relative to the S&P on longer-term time frames, but making some good progress. Shoulder, head, shoulder, neckline, breakout, retest, still above. The laggard, maybe a little bit like the S&P 500, doesn't look as good, but this is constructive, bouncing at the 30-week. We've covered this many times. This look here is telling us it's very, very possible that the S&P 500 is going to exceed this high. Notice I said possible. Breakout, retest, moving higher at a logical area. February 27th tweet, chart speaks for itself. Here's a Kirby Puckett cloud, 5 for 5. Green above price, we have it. Price above red, we have it. Blue above red, yep. Price above the cloud, yes, we came back and retested it, moving higher at the end of the week. Has the cloud flipped from red to green? Yes, it has. UK with the Roberto Clemente 5 for 5 look. This is very important because your leaders are holding on to and maintaining these constructive looks. This is concerning, and here that looks like a potential failure at the cloud. Many of these leaders have been above the cloud for several weeks, also holding above this breakout line here. Doesn't predict anything about what the chart's going to look like next week. We're trading the chart and the probabilities in front of us. Freddie Lynn 5 for 5. Important weekly here. Green above price, yes. Price above red, yes. Blue above red, yes. Still have some work to do trying to flip green here. You can see it. Need to get out here. Haven't done it yet. But we're not losing the cloud. Support, 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 support. Overshoot. Support. Still has a lot of support down here if it needs it. Thus far, it hasn't leveraged it. Came back below, overshot this, and has now recaptured it. Multiple month period of consolidation, didn't even come back to the neckline of that this time, came back to an upward sloping 50, and thus far have held and held well above an upward sloping 200-day. Economically sensitive and interest rate sensitive and demographically sensitive. Home construction. You can pause your video player here. This is what we want to see. This is what we want to see. It's starting to look better again. Still has some work to do. S&P 500 is red as of Wednesday night for the week, and then it's even more red Thursday morning. Looking very, very vulnerable, maybe doing an overshoot. But Wednesday night, this was the turn in the 200-day moving average in the NYSE noted on Twitter. You can find a lot of this on our Twitter feed. It speaks for itself, unequivocally. Holding a risk-on look over the past 3 weeks, bouncing above the cloud. Cleared the cloud in January, haven't even closed really near the cloud, maintaining a Ted Williams 5 for 5 look. Here's MACD here crossing below zero. This is after the major COVID low in 2020. Crossing above zero here in January of 2022. So this is risk on. This is risk off. This is the present day. And momentum is still, hasn't really even made a run back at the zero line. Talked about this, not unusual to come back. Here's your breakdown. It looks like we came back and retested the breakdown, and thus far, still maintaining a firm risk-on look. 20-day moving average moves rapidly from the top to the bottom. 20-day moving average moves rapidly from the top to the bottom. Then there's a retest look here, and all of that occurs after the major COVID low and looks nothing like January or Q1 of 2022. Another one looks different than all of this. Looks like a breakdown in favor of risk on. Looks like a retest. Hasn't recaptured anything of importance yet. Pause your video player here. Moving from here to here is constructive. Left shoulder, head, very shallow right shoulder, breakout above the neckline and a retest and a nice bounce. Still a laggard, but XLK is trying to break out versus SPY. If you're a stock market bull, that's what you want to see. You'd like to see tech and growth come along for the ride. They don't need to be leaders necessarily. They can't keep making new lows. After the major low in 2020, Q1 of last year crossing above the zero line, present day in 2023. Compare this look to this look and contrast this look with Q1 of last year. Everything that we said about the last chart applies to this chart. Remember last week we said if some of these areas that we've been watching, so let's say 3,900 to 3,950 start to give way, it's always good to know the next levels of potential support. Why is that? Because you don't want to get caught off guard. If this is going to fail, it's possible that it would fail very, very violently and rapidly. So last week we said this was our second line in the sand, and last week it was around 39.26, and we also had a potential support level at 38.82. So keep in mind, really this pink line here intersects with the bottom purple line. We did overshoot, and we came right down to the anchored volume weighted average price based on the close, the October close down here. That's why the line's up here. Intraday, you can see we came right down to these lines, the same lines that we showed as a possible area of support, came down and held. And then we recaptured this area here that we lost for a very short period of time. And this aligns perfectly with this concept that markets tend to overshoot. It's not unusual to take out these levels, trigger a whole bunch of stops, and then do exactly what the market did, which was reverse violently. This is like many charts. So far, so good. The look of this chart as of Friday's close tells us that the rally attempt off of the October low has somewhat been confirmed as long as this holds. We can really say the same thing for the December low. We overshot it, and then the market changed its mind. So this is holding from the December low, and this is holding from the October low. The longer above, the more relevant it becomes. Not assuming anything. It's possible the market could make a run at this 42.88 up here. Not a prediction. We'll move quickly. You can pause and read the bullet points if you care to. Early February, weight of the evidence said, hey, it looks like a new bull market. Last week, the pullback was right on the verge of becoming disorderly, but we said last week in a bullet point, we just haven't seen enough deterioration yet to warrant any major changes or really any significant changes. When the market hit the intra-week low, a lot of damage to a lot of charts. It was looking dicey. But as mentioned on Twitter, the tape, possible areas of support, asset class behavior, etc., consistently said, try to be patient. It didn't say be patient. Try means if we don't hold and things don't improve, then price rules. Price needed to make a stand. Had a ton of intraday outside reversals on Thursday, which means we exceeded Wednesday's low and then eventually exceeded Wednesday's high. S&P finished 117 points off of Thursday's low. Got some very convincing follow-through on Friday. Probably fair to say we're about 90% of the way to calling it an orderly pullback. Still have some work to do, especially on the laggard charts like the S&P 500 and the NASDAQ. Last week, not enough evidence to warrant significant shifts. Since the market was up this week, that's still true, and we're still in so far so good mode. Keep this in mind. We'd prefer not to make decisions at maximum anxiety. Think around maybe 10 a.m. on Thursday morning. So in terms of the bullish case, we're still at so far so good. We're not going to make any assumptions about what Monday looks like next week or the next 3 weeks. And as we all know, the only way any of this is going to work is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.